Most investors spend their time watching shifting stock market headlines. That's not us. We watch the deep financial currents. And while the market headlines changed again this week, the core macroeconomic currents did not. Today, we're breaking down why the US economy continues to expand, why AI expansion is accelerating, and why the financial system is quietly positioning for a massive shift in interest rates. If you want to know how to navigate this market using an income focused strategy, you need to look past the noise. That's hard when you've been trained to pay attention to every distraction. But if you can look deeper, you'll discover there's more to the market and more to life than what's easily seen. We've discussed the hidden bond bull for weeks. Are you positioned for the deep water bond financial current that is flowing right now and gaining speed? Let's dive into the data. So, hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy and closed end funds. It's not polished, it isn't scripted, and it's definitely not hard thinking. We don't chase headlines, we navigate markets. Now, let me be clear, I am not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. So let's step into this week's waters and see what's actually moving. At least 95% of the stories I read every week focus on the headlines. Inflation did this, jobs did that. AI companies spent another mountain of money. Stocks moved, Bitcoin moved, the market reacted. But here's the problem. Most investors confuse motion with movement. A headline moves, a wave happens there, a ripple is felt there. That doesn't mean the financial currents have changed. And when I look past this week's headlines, I still see the same currents I've been discussing for months. The economy continues to expand, energy production continues to increase, technology continues to advance, AI continues to accelerate, and capital continues to flow. The noise level varies and the surface keeps changing, but the currents aren't shifting. One of the most overlooked stories in the market right now isn't inflation. You wouldn't know it because that's all they talk about. But the biggest story is deflation. Besides this channel, I've seen very few analysts seriously discussing it. Most continue talking about permanently high rates and permanently high inflation. But if you follow the data instead of the narrative, a different picture emerges. Wage growth continues to slow. Consumers continue pulling back. AI continues increasing productivity, and productivity is inherently deflationary. It's cheaper, faster, and more efficient. That's what AI does. The same goes for energy. Eventually, the Iran conflict ends. Shipping routes normalize, oil flows freely out of the Middle East, and when oil falls, costs across the economy will fall with it. Now, add in Kevin Warsh stepping into the leadership at the Federal Reserve. He has repeatedly stated the Fed should follow the data, that the Fed has often been behind the curve, that AI is deflationary, and that lower rates will eventually be appropriate when conditions justify them. The question isn't whether rates move lower. The question is when. And this is where most investors get distracted. They see AI and immediately think of technology stocks. That's understandable. AI is the flashy story, it's the visible story, but it isn't the whole story. To understand what's really happening, we need to step back. I've been trying to find a simple framework to explain AI. And here's the best one I found. I actually created this a couple of weeks ago for this video series. Every major technological advancement comes from two parent branches, hardware and software. Everything else grows from some combination of those two foundations. Every generation improves upon the generation before it. Most advancements are evolutionary, though occasionally one is revolutionary. The internet was one, AI is another. And that's why AI feels different. We're not watching another product cycle. We're watching the birth of a new branch on the technology family tree. But branches don't grow without roots. That's the part most people miss, or most investors miss. AI still needs financing and infrastructure, energy and capital, and an economy capable of supporting the expansion. That's why I keep talking about the economy, because AI doesn't replace those systems, it depends upon them. A strong economy builds sidewalks and roads, pipelines, power grids, data centers, cooling systems, financial networks, and provides the capital required for every single stage of expansion. The age of AI doesn't continue without those foundations. And almost everything is in place. We're simply waiting for the rate environment to catch up, which is why I continue placing bonds at the top of our existing flowing currents or current structure. Not because they're flashy, because they're not because bonds dominate headlines, which they obviously don't, but because bonds finance growth. The fasting flowing currents remain bonds and select bond proxies, real estate, end to end energy, and the technology family tree technology, software, AI, hardware, and the infrastructure beyond the large caps. Most investors are focused on the visible AI branch. I'm focused on the root system feeding it. That's where the opportunity exists. So, with that in mind, let's move into this week's closed end fund snapshot and look at the funds positioned inside the strongest active currents. But remember, success isn't about finding the single best fund. It's about finding funds positioned inside actively flowing financial currents, really those top four. And when the current is correct, the fund selection process becomes dramatically easier. So let me share my screen and we will get into this. So it's an initial lengthy list. I think there's 13 funds listed, but they're not all going to stay. 13 funds. HFRO makes the list simply because it's got the greatest discount or one of the greatest discounts still. But the price has climbed. The dividend, thankfully, has been consistent, but because the price has climbed, the dividend has lagged. And below 7, I mean, my typical cutoff is 9% or below. So below 7 is still pretty low. PDT stays simply because I think it's positioned well for a coming lower rate cycle, but I'll circle back to that. If you want constancy, um, especially for international bonds, that's AWF. On my end of things, I mean that. So the constancy, they don't change the dividend. Higher, low price, high price, the dividend stays the same. That's the constancy of it. That's great, but at below 9% with no change in dividend just outside of the constancy, it's hard to justify keeping it on my list. I tend to be, I mean, honestly, I tend to be more aggressive. That's how most people would call it. But um, I, I'd prefer to look at it more like logical and data driven. And at below 8% with no other justification, I mean, I'll confess it's on my hit list. I would just like to find it when it's got, a higher dividend than what it has right now. Not so much dividend, like a dividend price per share, but just the actual dividend yield. Um, DLY stays, so now we're above 9%. DLY, all of this stays. That'll stay for right now. HGOB is going to leave. Uh, I I thought about buying HGOB last week, but I did not. I passed on it, and I'm glad I did because Fermi just continues to lag. Fermi has this great idea, but they are struggling to find clients. And And reading the recent release of information online, they're just struggling as a company. Um, let's see, BRW stays, PDI stays, IGR stays. I did not buy IGR last week. I thought about it. It's still a great dollar cost average, but it was premium last week, and I waited because I wanted to demand a discount. This week it's got a small discount, but if I bought it, I would pick it up because its price is almost a dollar less than our average buy-in, and that's just a great dollar cost average move for me. So of this list, every single fund operates inside those four currents, but it's really, if you look at them all, it's bonds, real estate, which is also a bond proxy, but I give it its own category too. So you have bonds, real estate. BRW is the exception. It is like it really is just an all-terrain income vehicle. It's like a hedge fund, but just it is pedal to the metal. Let's see. So we have real estate, bonds, the income vehicle, lots of different bonds. That's a very structured play. And then we have PDT. And in my work today inside this ongoing spreadsheet, I tweaked the ID cards into, well, let's just say I put more information into them. But it's got a great synopsis now. The overall focus, individual specs, the where they're allocated, the key sectors where they're allocated. But in summary of all of this, I've also added just this. I don't want to say simple statement, but a easy clarifying statement at the top. And in doing so, I've cleaned up my spreadsheet a little bit. So I have all the notes by the ticker. I've got really the economy sector for the most part here. And then the target notes is just the data relating to that specific fund, not all the other notes that you would find either in the economy or under the ticker. Um, so PDT makes the list because, yes, it's got a dividend below 9%, but it makes the dividend of what it makes the list based on how they're set up heading into what I still say is a lower rate cycle. So if you look at their dividends over the lower rate cycle, their pricing has been what you would expect, up and down based on the economy, right? But with lower rates hitting at a premium, that doesn't mean the price necessarily climbs. I mean, it would be great if it climbed, but that doesn't necessarily mean the price outright climbs. But distribution wise, at this dividend rate, 0.0975, the yield jumps to just above 9, but they have a history of paying special dividends during low interest rate cycles. So if we change this dividend to that lower interest rate cycle, it jumps above 9. Uh, but it, gosh, with their sector, their tranches of allocation between their preferreds and their energies, both should do well. And yes, everything should do well in a lower rate environment, but their preferreds should be worth more. And like we've seen elsewhere, uh, it's just a great cycle to pick up energy stocks. So I can argue for everything on this list, but I only have so much money and you only have so much money. So how about I show the contact cards and you can pause the screen and read, and then I'll give you my top four most tempting funds. So we got IGR. You can pause and read. Let's see, PDI, same thing. You can pause and read. Only so much I can display for some reason. BRW, PHK, let's see, PAX, DSL, let's see if I can get a better screen of this. PTY, there we go. So you can pause this one and then read a little bit more below it. Let's see, PDO, which is a term fund. DOY, that is also a term fund. The term is not stated, but the suspicion is that it's gone in the next 6 years. And then PDT. Let's see, can I get a better box for PDT? Yes, I can. So I could argue for everything, and the stuff in light blue and dark blue we already own. It's tempting to pick up another another PIMCO fund, but to be quite honest, I don't know if I need a fourth PIMCO fund. And more so, 16 is my general cutoff. I really don't like buying funds 16 and above. And even, yes, it's almost $16, it's almost $17. It, it tests my comfort zone. The same can be said of PACs. Like, do I really need another PIMCO fund? They're very similar in nature. PHK is the legacy, PTY, it's hard to go against. PDO is a term fund, but do I need another one or do I need another two? And to be honest, uh, I would ask AI to compare them all and show me the overlap. And if I really need two other PIMCO funds, like at what point am I just diluting my investment by continuing to invest in things I already have somewhere else? So PDI is interesting just because it is that aggressive and has this currently sustained dividend, but I don't know if I need another PIMCO fund. IGR is interesting for me because it's almost $1 less than our current buy-in. If I didn't already have it, I would demand the actual historic, the double the historical and greater than the 5-year target discount. So for the Roth portfolio, it's on my wish list, but it doesn't meet the target for that. But since I already own it in the cash brokerage, I'm willing to allow myself the dollar cost average pickup, especially now that it's in discount territory. BRW is always interesting, but it's the fund where I have the most shares right now, and I'm trying to. It's that weird balance of not putting all your eggs in one basket, but at the same time not diluting your investment to where it doesn't grow. PHK I already have about the same price. PTY, PDO are going to fluctuate. So on my end, so IGR, PDI, DSL is tempting because it's not it just it's not this heavily discounted this often. It's if you look back at recent weeks, DLY has been running a discount, a significant discount, still is. But DSL has not fit the build, and for whatever reason, it does this week. So it's tempting. Um, the other, in my end, is PDT. And simply because I don't know if I can get this Comcat card all the way out again, but I will try. There we go. Simply because of its structure. I get that it's got common stock equities at about 40%, but that's it doesn't seem completely accurate because about 80% of the fund is invested in preferred stocks. So it, I think that's a little bit skewed because it's definitely not a stock environment. It's a bond and bond proxy environment, and the energy part of their fund fits the bond proxy narrative, bonds and bond proxy narrative, and the hybrid preferred. Uh, you could argue that it's a bond proxy, even though it's kind of its own thing. But for the current market and what I still say is the coming market of a lower interest rate and this hopeful dividend change, which I guess we can go back and make it accurate based on now, 0.0825, right? I get that it's below the 9% threshold, but of what I hope is coming, lower rates, I'm hoping that dividend would go up. But those are my top four: bonds, bond proxies, and I'll call it at that. If you want the full list, well, I'll pop the full list back up for you. Not HGB. Yeah, so there you go. Here's our original 10 pack, and my 4 pack would be IGR, PDI, DSL, and PDT. There we go. And you can take it where you leave it. So I'll leave you with this. The headlines are easy to find. The real story usually isn't. Most investors spend their time looking at reflections on the surface. They look at yesterday's winners, yesterday's headlines, and yesterday's excitement. All of those things are reflections. We're looking for currents, but not every discount is a bargain, and not every premium deserves attention, and not every popular investment is positioned for what's coming next. The goal isn't to chase what's already happened. It's to position for where the current is going. Most investors are still, frankly, they're still shooting buckshot into the market and hoping they hit something. The income radar system is different. We identify active financial currents first, and then we target the funds already floating inside them. That's the difference between firing blindly into the fog and shooting fish in a barrel. Look, the headlines will keep changing, and the herd will keep chasing reflections. What will you do? As for us, we'll keep following the currents because when you're positioned inside the right current, the market does the heavy lifting for you and pays you while it pulls you forward. So that's all I have for this week. I will see you next Sunday. I wish you a great and successful week across all of your endeavors, whatever you have going on. I know I've got quite a lot to do this week, but I wish you a very successful week. So if you have a comment, have feedback, or want to share your own experience with closed-end funds, by all means, drop it in the comments. And otherwise, I will see y'all next Sunday. Have a great week, everybody. Bye-bye.